one thing that's very important to understand is risk. No matter what investment you're making, understanding that risk and its relationship to reward is very, very important. In fact, risk is the other side of reward. It's like, yeah, we want these great rewards. We want our stock to go up or our bond to pay us or whatever it might be, but there's risk to that. It's not a free lunch, so to speak. So risk is the other side of reward. And if you want more reward, what you need to do is take on more risk. If I have cash in my pocket, well, that's less risky than if I invest in a stock, for example, because that stock could go up, which would be a great reward, but it could also go down. In fact, it could go all the way down and I could lose everything versus having cash in my hand. I can go buy something now today. Very less risky with that cash than with stock. And all investments have a matter of reward and a matter of risk, and it's really evaluating between those. And there's different types of risk. So let's take a look at the different types of risk and understanding that. And so there's some good news with risk as well too that we'll talk about in a moment. So first off is understanding the different types of risks that are out there. And the big one that's out there is market risk or systematic risk. You might hear it, stated out there. And that is like that the whole market does things. You've seen like the S&P's up or the Dow's up or the Nikkei's up or whatever is up or it's down, and it's pulling everything up or down with it. So there's a systematic or market risk that's associated with different markets you invest in. If you're investing in the stock market, that's a market. The bond market is another market. So if interest rates rise, that's going to affect bonds and negatively affect bonds. So the bond market will struggle. So understand that there's systematic risk in no matter what you buy. So stocks as a systematic or market risk are more risky than investing in cash, and thus you get potential, especially over the long term, a better return on stocks than you would cash over the long term. Over the short term, anything can happen. They could go up or down, and that's why stocks have more volatility or they change in prices quickly because they can go up and down much more quickly than, let's say, cash. So there's market or systematic risk. Next one is business risk. The threat of, let's say, the business failing, that particular business you're investing in failing. That's like things like bankruptcy. So if I buy an individual stock, that stock could suffer or they could go bankrupt. They could completely fail. Maybe I mitigate that risk by buying a bunch of different stocks, or maybe I buy a mutual fund or exchange traded fund that has a lot of different stocks, thus reducing my risk of having the business risk of one, let's say, company struggling or going bankrupt. Though a whole industry could struggle too. Like it'll be more of a business and systematic risk. So risk around that, what is that individual investment, or maybe let's say like a company in terms of stock, what is that risk associated with that specific company, that business risk? Another one is credit risk. What is the idea of credit for that organization if they get downgraded as far as credit, so it's harder for them to borrow money or more expensive for them to borrow money, or from a credit rating service, or from a credit standpoint, the solvency of that company, of a credit risk. Another risk that you have is taxability risk. What happens with taxes? Do taxes go up on a particular industry? Do taxes go down in a particular industry? And what about your own individual taxes that you might pay on capital gains of your investments going up, or paying on income that might come out in the form of dividend that's risk to you as far as taxability? But then also organizations and things have taxable risk too as well. I know in the United States, the first incarnation of the Affordable Care Act, also known as Obamacare, you might have heard of, is, they had all sorts of things as far as health care in the act, but one of the things they had in there was an extra tax on medical device makers. So companies like Medtronic, Boston Scientific, Johnson & Johnson has a medical device area, St. Jude, all those, St. Jude Medical, all those had incurred an extra tax by that government regulation. So they had a taxability risk associated with that. So understand, a medical device maker might suffer more from Obamacare than, let's say, a pharmaceutical, which did not have a similar tax. By the way, that has been changed, and now it's better for the medical device manufacturers as far as the taxes. But that could change at any moment. People write laws and taxes all the time. That's what our governments do. Next is interest rate risk. What's happening with the interest rates overall in the global economy or within particular markets? What's happening in Greece or the European Union or countries within that, the United States, wherever, Japan, China, wherever it might be, looking at overall interest rates and what happens within maybe particular companies and then our countries, and overall interest rates that might be happening all over the world. So for example, An asset class that has very sensitivity to interest rates is bonds. When interest rates rise, bond prices fall. So if you own bonds, your bonds are worth less. Now, if you're going to buy new bonds, you'll get a higher return or a higher interest rate because they pay off interest rates. That's maybe a good thing for buying new ones, but your existing ones go down. So if you own bonds in your portfolio and interest rates rise, especially if they rise quickly and substantially versus over a longer period of time and more smoother, that's going to really hurt you if you own, let's say, bonds. But interest rates can also hurt companies too. When interest rates rise, it makes it harder for companies or stocks, the stock you might own, to borrow money. So that might impact some companies who want to borrow money to invest in their companies. So that could hurt your stock portfolio as well. Inflationary risk, well, that's the cost of prices or goods going up for you or me. And that can vary by industry or sector. Maybe, dairy or milk products prices are rising faster than something else that might be more steady or more flat. I know, for example, in the United States, as one example, although we have things all over the world, but in the United States, the cost of higher education, college, university, and healthcare in particular, those two sectors, those two areas, the cost of inflation, the prices are rising much faster than the overall economy's inflation rate. And that could be good if you're owning stocks or certain stocks, possibly. They can charge more, or it could be bad too, especially if you want to send a kid to college and you're paying for that. That could be really bad, to have prices rise that quickly. So understand that inflation could hurt things. Things like commodities that you might be investing in, just like soybeans or agriculture stuff, or pork bellies. I always thought that was a fun one. Pork bellies, these commodities, or oil is a good example too. If the prices rise or fall dramatically with oil, what is the impact of that? When prices drop really significantly, that hurt oil and natural gas and companies that are associated with oil or movement of gas or natural gas. As that might help us individual consumers. The gas prices are going down, but it hurts those companies, and you're invested in those companies. Well, understand that could be an inflationary risk there. Liquidity risk gets really around debt and liquidity of organizations. How solvent are they? You can look at things like debt and equity ratios. What is their ability to pay their bills? So that's kind of looking at liquidity risk. So if you're looking at a company, for example, and it has a lot of debt, it might have a harder time paying its bills than a company with no debt. Now, you could also argue it might be a good way to invest in that money, and they're taking on debt to invest, and they're going to be a growth stock and really grow that price. That's great, but you have a liquidity risk where they might not be able to pay their bills and thus reduce their earnings, reduce their dividends, maybe cut their dividend if they pay dividends, or maybe even go out of business and get back to that business or bankruptcy risk. There's also social, political, and regulatory risk, right? We talked a little bit about the Obamacare or Affordable Care Act in the United States, but anything around regulations or social things or political things that might be happening out there. If you're investing in a particular type of thing and that's, now looked on poorly or whatever, that's a big risk there. So like Altria, which has an arm called Philip Morris. You probably know Philip Morris. They make cigarettes. There's been a large movement over the last several decades against cigarettes, the health problems associated with cigarettes. So that stock is hurt by those types of things and regulations around that and fines around that and maybe other social political things around tobacco. Doesn't mean they're not a successful company. They are, and they pay a pretty good dividend. You can decide whether you want to invest in a company. Those are called sin companies, that things like defense contractors or gambling companies or tobacco companies, things that are kind of considered sin type companies. You can decide whether you want to take on that risk, but you have more, let's say, political and regulatory risk with, let's say, a tobacco company than you may, let's say, with some other companies. But all companies are susceptible to risk around regulations, societal changes, and politics. Next, we have currency or exchange rate risk. What happens when a currency rises or falls? And what does that impact maybe your holdings if you own currency or cash, or if you're owning things like even individual companies that might be global companies. So if a company, let's say, is a United States-based company, but most of their sales are overseas, the rising dollar makes it harder to, let's say, sell goods maybe in other parts of the world, and that could impact their earnings and impact their sales versus other companies. And last, a risk that's kind of really most associated with, or is associated with mutual funds and things where you have a fund manager making decisions on investments is fund manager risk. You might hear of this with like actively traded funds where a manager is making decisions on buying and selling versus like an index fund, which is not. It's all just following an index like the S&P 500 or a total stock market or a bond portion of the bond market where it's not based on individual choices of a manager. It's just automatic. You're following the trend or following the entire index. fund manager who's actively trading, you're betting on that manager. You're betting that that manager of that fund is smarter than the other managers out there, is making good purchases and sales of investments within that fund. So if it's a stock fund, they're buying and selling stock that goes in that fund based on their experience and what they think is good. But there's a risk that that manager might be making bad decisions, or bet on an area of the economy or sector that ends up going downhill and they made a bad choice or a bad decision. Or let's say that fund manager has been around a long time, very successful, but then they decide to leave, they retire, or they leave for another company or something. Well, now you've got a new person coming in. How are they going to do in that fund? So there's risk along that too. So sorry to be a little long-winded on this one, but there is a lot of different types of risk and risk types out there. Now, the good news is that you control the amount of risk that you want to take, right? We have all these risks, we have all these factors in there. The good news is you can decide whether you want to take on a lot of risk or less risk. You can buy a lot of stocks and individual stocks and take on more risk, or have a more diversified portfolio around cash and take on less risk. Remember that risk and reward are intertwined together. More risk, hopefully you'll get more return, is the idea behind that. And also risk is reduced over the long term. An individual stock could go up wildly within a day, 10, 20, 30% sometimes even within a day. Hopefully not that much, but it can happen. It has happened, up or down. So in a day or two or a week or month, they can be real volatile with things like stock or change their prices quickly. Versus over a long term, a year, 2 years, 5, 10 years, that's going to smooth out that risk over time. And that's the idea, is you want to maybe reduce that risk by having a diversified portfolio of a lot of different assets, stocks, bonds, whatever, and then within those assets having diversification in that to reduce your risk. Large cap, small cap, medium cap stocks, growth and income stocks, different sectors or industries they're in to help mitigate that risk. But overall, the thing to take home is that risk takers are rewarded. At least what all the back history shows as far as the markets, long-term investors using things like compounding interest and regularly investing, especially if they can automate that investing, are very, very successful. And I speak from that from very personal experience, and I'm very grateful for that. I'm grateful for those powers of compound interest and things, and being a saver and being an investor over time, because that risk has been mitigated. But when it's happening, when it's going down, it doesn't feel good for sure, but over a long period of time, risk is mitigated and reduced. So here, now you know a lot about risk and risk types. Don't let it freak you out too much, but just understand that when you're making investments, that there's risk there, and different categories of investments have more risks than others. A big consideration for any investment, and particularly for stocks, is an understanding of the risk of that particular investment you're going to make, whether it's an individual stock or a stock mutual fund or whatever it might be, and how to calculate that risk so you can kind of compare when you're making investments, so you have an understanding of, hey, this might be a very risky stock or risky stock mutual fund versus one that is less risky. And when we talk about risk, we're really talking about volatility. How much does it go up and down? What is its ranges as far as the returns on this type of investment? Because that's important as far as understanding what might be to your own level of risk and how much you can kind of stomach. As far as something going down 30%, can you handle that? Or having these wide swings, or do you want something that might be a little safer investment and less wide swings? So you're looking at that variance, that volatility. Well, there's two big measures around that. There's a lot of measures, but the two big ones that are out there, which are standard deviation and beta. And standard deviation, you see a lot around mutual funds. A lot of stock mutual funds talk about standard deviation. And then a lot of individual stocks, you see in comparison, they're looking at beta. And they're two different things, similar as they calculate risk, but how they come about it are a little different. It's standard deviation, beta. So we'll follow along those same principles and think about standard deviation around mutual funds and stock mutual funds, and beta around individual stocks. And we'll take a look at that. In the next lesson, we have some examples where we'll do a demo and we can kind of see where to find this information and see how it kind of works. So let's get started with standard deviation, and let's think about that in terms of, let's say, mutual funds, but it could be anything. But really, let's think about mutual funds. And the idea is that you're trying to get an idea of the variance, or measure how the fund compares to its own average. It's not comparing to an index or anything. A beta actually does that, but comparing it to its own measurements, its own range of highs and lows, all right? And you're really trying to look for that variance, that deviation from the standard or the mean, the average, right? You're looking for that variance. So, for example, if you have a 12% annual return, or average annual return, that is a 12% average annual return, over a period of time, like let's say 3 years, or 5 years, whatever, you're looking over a period of time. if yours is 12% average annual return, and your range of that is some years it's 8%, or some years it's 16% over that period of time, say 3 years, anything, that would be a standard deviation of 4%, right? You're 4% below, and you're 4% high, that's your range, and that's your deviation behind it. As far as a quick way to think about that in terms of, let's say, returns and returns of a fund or returns of an investment. So basically, the greater the swings, the higher the standard deviation. So if I have something that trades in a more narrow type of gap of, let's say it's a 12% return with a high of 13% and a low of 11%, well, that would be pretty good investment by itself, but let's say that's only a 1% standard deviation. That's pretty safe, actually, and less risky versus something that has a high standard deviation, a high level of volatility. And the more volatility, that's another way of thinking about the more risk that you have on it. You actually don't realize these gains until you sell, of course, but you can see how it might vary over time. That's why stocks with a high standard deviation over a short period, you might lose money because you're only going to hold it for a year. Well, you don't have a chance to maybe come back if it ever does, or a mutual fund to come back. You still might want to make that change just from better investments, but that's why stocks and stock mutual funds are a longer term investment because they have higher standard deviations than, let's say, like a bond or cash. So that's standard deviation, comparing highs and lows versus its own returns, its own measurement. Another way to look at stocks and stock risk is beta. And beta is really good to use for looking at individual stocks. So a lot of people use standard deviation with mutual funds. You could use beta with mutual funds too. But a lot of people use stocks or use beta for individual stocks. Because the difference between that and standard deviation is standard deviation looked at the individual investment comparing itself. Beta looks at the overall market and compares that individual investment towards the overall market or an index, or comparison within the index, for example. So if it's an S&P 500 index that's being compared to, and you have one S&P 500 stock, let's say it's Apple or whatever, you can get a beta measure to see what is the volatility as compared to the index. So if you have a real volatile index, like a stock index or a technology stock index, the whole thing is going to be more volatile than maybe something like utility companies, which are just by nature less volatile, but you can compare to a larger market using beta. And there's a measurement or a number behind that. You don't have to worry about calculating the number. In the next lesson, when we do the demos, I'll show you where to find the number fast and easy. But basically how it works is the beta of 1 or 1.0 matches the index or matches what you're comparing it to. So if it matches the index, it's going to have a beta of 1. Let's say an individual stock is going to match that index. If it has a beta of greater than 1, versus, let's say, the index, then the higher the number, the bigger, the greater than the number of 1, well, then that's the more risk or the more volatility in comparison to the index. So if it's greater than 1, it's going to go up and it's going to go down more than the index as terms of risk and return and reward over terms of volatility. If the beta is less than 1, that means it has less risk in comparison to the index. So if the index is way up, this won't go up as far, but if it goes way down, it won't go down as far either if it has a beta of less than 1.0. So in a nutshell, 1.0 is kind of the standard comparing to the index, and if you're above that number, you're a more risky individual investment or risky stock, more volatile, and if you're less than 1.0, you're less risky or less volatile, less changes in your price over a period of time. So standard deviation and beta are a good way to look at things and say, boy, is this a risky investment? Is there a numerical measure I can use? And yeah, these two will help you out with that. Okay, I just typed in investment risk calculator, came up with a couple of different options, whole thousands of different options really, and I happen to chose one of the top ones that are out there. This is from VISSF. They're an Australian-based financial services firm. I don't do business with them. I don't really know them, but I popped up with their calculator. I thought they had a kind of a nice, easy-to-use calculator that kind of looked nice on the screen too, but it was a nice, easy to calculator. So I'm at VISSF in Australia. Here's the link on the top there, and it's under calculators risk profile. All right, so we're going down here. It says risk calculator. What risk profile is right for you? And then a lot of times what these calculators do is they'll give you a series of questions, and if you answer these questions, they'll give you an idea. It'll spit back a report saying, oh, you're an aggressive investor, or you're a conservative investor, or you're somewhere in between. So like here's an example of a question. I seek the maximum possible return even though it may take several years to recover from potential losses in an extended down market. Am I willing to take that risk or not? So let's say I agree with that statement. You might be different. Let's say I agree. Maybe I don't strongly agree, but let's say I agree. And then I click next. And then there's more series of questions. I'm uncomfortable with potential losses during extend down market that way. I prefer investments with the lowest possible risk, regardless of return. So if I'm really risk averse, I might be like this, and I would strongly agree, but I'm less like that. I'll say I disagree on that as well. And you go through these questions and, what do you want to keep up with inflation? Yeah, I certainly want to do that. I'm willing to take risks to do that. Maybe I'll even strongly agree with that. And you go through and you answer the questions. There might be like a dozen questions typically in these types of risk calculators. I've done it, so I like a cooking show, where they show you how to make the item that they're cooking, and then they show you the finished product, so you'd have to watch it bake. Well, it's kind of the same thing. You don't have to watch me answer all these questions, but to give you an idea what my report looked like when it came out. It said I had a score of 31. I'm not even sure what that means, but it does say that I have a balanced level of risk. And then it gives usually like a little statement here that I'm prepared to take with their goal of achieving higher returns over the long term. So I'm able to take some risk, but I want those high returns over the long term. Yeah, that's certainly me. And I prefer to invest in a combination of growth and income assets, weighted more towards growth. And when they really talk in the green here with growth assets, they're thinking like stocks, and income assets being more like bonds would be another way to say it. So sometimes these calculators will spit out like this much in stocks, this much in bonds, this much in cash. Cash is the three main interesting. This one is kind of like growth and income. Green for, I would say, more like stocks, and gold there, or yellow for income. And it may invest 60 to 8% of your shares in property and stuff like that. So the breakdown of that number as for 60-80% breakdown between the two balanced levels. So I have this balanced level of risk where maybe I have 60-80% in growth and maybe 40 to 20% in income assets, or some type of balance with that. If I was a real heavy aggressive investor, it would be mostly all green, and if I was really more conservative, it would probably be mostly all yellow. And this is different for me. We were talking about how investing changes over time. When I was a younger investor, definitely would have been much more green, would have had some gold, but I had that longer time horizon. Now that I'm a little bit older and I'm looking at financial plans, I'm looking at retirement, I'm looking at what the future holds. I've had success with investing. Now it's a matter of maintaining and holding on to that and generating income from it. So that's where I'm still more balanced, even though I'm still looking for a lot of growth. Hopefully we'll live a long time, so still have a long time horizon, but that's where where I come out in the score. It's not a yes or no, this is definitely who I am or definitely who you are. It's a way to get the conversation started and start thinking about the types of investments that you want to have in your portfolio.